specific file, a specific moment. Each one produces a measurable result within a defined boundary, and none of them answer the question that every borrower who has worked this hard to understand the system eventually hits. Not how do I fix this number, but what am I actually building, and what does it ultimately produce for the rest of my financial life? That question is bigger than any single component. It is bigger than the score itself, and the answer to it is not a technique. It is a perspective, one that separates the people who spend years optimizing a number from the people who build a structure that makes that number a natural, automatic outcome of the way they live. What comes next is that perspective. The financial case for everything you have learned, measured in real dollars across decades. The habits that elite borrowers have already internalized without thinking them. And the final truth about how this system actually works, which is that the file you build quietly over time in the background of an ordinary financial life speaks louder at the moment it matters than anything you could ever say out loud. What you are actually building and why it matters beyond the score. Every strategy. In this course, every technique, every distinction between terms, every timing, consideration and documentation requirement points toward a number, a 3-digit number that you did not choose, that you cannot see being, and that influences decisions made about you by people who will never speak to you directly. It is easy, after 20 topics of mechanics and methodology, to lose sight. That number actually represents and why the effort required to understand and improve it is justified by something more substantial than the score itself. The score is not the destination. It is a measure of something real, and what it measures imperfectly and incompletely but consistently enough to matter is your demonstrated ability to manage financial obligation over time. The system rewards on-time payments not because the bureaus have a moral interest in punctuality, but because consistent payment behavior predicts future payment behavior with enough statistical reliability to be useful to lenders who make probabilistic decisions about millions of borrowers they will never. The score is a compression of your financial history into a single number. Lender can use in a few seconds to make a decision that will affect years of your financial life. Understanding that compression and understanding how to present your history in the most accurate and favorable form that the scoring model is capable of. Recognizing is not manipulation of the system. It is literacy in the language the system speaks. A person who knows how utilization is calculated and keeps their reported low is not gaming the model. They are demonstrating in the terms the model is designed to measure that they manage revolving credit responsibly. A person who monitors their file for errors and disputes inaccuracies is not exploiting a loophole. They are exercising a legal right to be evaluated on accurate information. The difference between financial literacy and financial manipulation is the difference between speaking the language correctly and forging the document. Every strategy in this course falls on the literacy side of that line. The downstream consequences of a strong credit file extend far beyond the lending relationship. The mortgage rate differential between a borrower with a 620 score and a borrower with a 760 score on a 30-year fixed mortgage can exceed $100,000 in total, paid over the life of the loan. That is not a rounding error. That is a material difference in lifetime wealth accumulation that compounds directly from the credit score at the moment of application. An auto loan rate difference of 4 percentage points between two borrowers. Different scores on a $30,000 vehicle produces thousands of dollars in interest over a 5-year term. A security deposit waived for a renter with a strong credit profile represents hundreds of dollars kept in the tenant's pocket, rather than held by the landlord. A year. These are not hypothetical benefits. They are concrete financial outcomes that the credit score determines repeatedly. Across every major financial decision a person makes across decades of adult life, the population that suffers most from credit system opacity is not the that lacks discipline. It is the population that lacks information. A person who does not know that utilization is calculated from reported rather than actual spending will never think to time their credit card payment before the statement closes. A person who does not know that authorized user accounts can transfer account age to a thin file will never think to ask a family member with an established account. A person who does not know that a pay-for-delete negotiation is possible simply pay the collection and receive almost no scoring benefit from having done. The system does not explain itself. It produces outcomes, and the people who understand the mechanisms behind those outcomes are positioned to produce better ones. The arc of credit building across a financial life follows a consistent people who approach it deliberately. The early years are about establishing history, creating positive payment data, managing utilization from the beginning, and building the file with the right account types in the right sequence. The middle years are about preservation and optimization, avoiding unnecessary account openings, managing the accounts that exist with discipline, resolving any negative items efficiently, and maintaining the utilization and payment. The scoring model rewards most heavily. The later years are about leveraging the history that has accumulated, accessing the best rates on the largest financial decisions, and protecting a well-built from the identity theft and fraud that becomes more economically motivated as the file becomes more valuable. None of the strategies in this course require extraordinary income, financial products, or access to tools unavailable to the general population. The authorized user strategy requires a relationship. The credit builder loan requires a small monthly payment. The credit freeze requires 15 minutes and an internet connection. The dispute process requires a letter and a stamp. The utilization strategy requires knowing when your statement closes. The rent reporting service requires enrollment in a product that costs less. Streaming subscription. The mechanisms are accessible. The barrier has always been knowledge of their existence and understanding of how to use them. The credit system will continue to evolve. Scoring models will be updated. New data sources will be incorporated, and the weight assigned to various factors will shift as lenders refine their ability to predict borrower behavior. The specific numbers and thresholds discussed in this course will continue to subject to revision as the industry changes, but the underlying principles that consistent payment behavior matters more. Any other single factor, that utilization is a dynamic variable that responds immediately to action, that the length and composition of a file produce compounding benefits over time, and that errors in the file cost real money until they are corrected, will remain structurally true as long as credit scoring exists in a recognizable form. You now understand more about how the credit system works than the majority of people who are being evaluated by it every day. That understanding is not theoretical. Applied consistently, over a timeline measured in months rather than years for most impactful changes, it produces a measurable score improvement, a meaningful rate reduction, and a compounding financial benefit that justifies every spent in this course many times over. The score is the measure. The money is the point. The knowledge is what connects them. Insurance scores versus credit scores. The shadow system affecting your premiums most. People who have spent time optimizing their credit score have done so with a specific goal in mind. A mortgage approval, a better auto loan rate, a credit card with real rewards rather than a secured card with a deposit. Requirement. The audience for their credit file as they understand it is lenders. What most of them do not know is that a version of their credit data is being used by an entirely separate industry to make an entirely separate set of financial decisions about them, decisions that affect what they pay every month for car insurance and homeowners insurance, and that the scoring model behind those decisions operates by different rules, uses different weightings, and produces a different number than anything a lending institution has ever shown them. The insurance score, also called a credit-based insurance score, is a scoring model developed and maintained by the same companies that produce lending scores, primarily LexisNexis Risk Solutions, which produces the KLU report. Insurers and the major credit bureaus working with actuarial models licensed to insurance carriers. The model draws from the same underlying credit file data that lending scores use, meaning your payment history, utilization, length of credit history, credit mix, and new credit inquiries are all inputs. But the weighting of those inputs is calibrated differently because the model is trying to answer is different. A lending score predicts the probability that you will default on a debt. An insurance score predicts the probability that you will file, and the actuarial research behind insurance scoring consistently shows a statistical correlation between certain credit behaviors and claim frequency. Consumers with lower credit-based insurance scores file more claims on consumers with higher scores, and those claims tend to be more expensive on. Insurers use this correlation to adjust premiums, assigning higher rates to lower scoring policyholders and lower rates to higher scoring ones. The logic is the same as lending risk pricing. A borrower who statistically represents more risk pays more for access to the product. The difference is that the consumer did not borrow anything from the insurance company. They bought a policy, and the pricing of that policy is being influenced by a credit file, most of them have never reviewed in the context of insurance at all. The legal landscape around insurance scoring varies by state in a way that has parallel in the lending world. 7 states currently prohibit or severely restrict the use of credit-based insurance scores in underwriting or pricing decisions. California, Massachusetts, Michigan, Hawaii, Maryland, Oregon, and Washington have statutory or regulatory frameworks that limit how insurers can use credit in the personal lines market. In every other state, insurance scoring is permitted, widespread, and unregulated, beyond the general prohibition against using credit data as a sole basis of coverage. If you live in a state that permits insurance scoring, your insurer is almost certainly using a version of your credit data to price your policy, whether you informed of this at the time of purchase or not. The factor weighting in insurance scoring differs from lending score weighting in ways that matter for optimization. Payment history carries significant weight in both systems, which means the same. Consistent on-time payment behavior that builds a strong lending score also contributes positively to an insurance score. But insurance models tend to place higher relative weight on certain utilization behaviors, particularly the presence of high balances across multiple accounts simultaneously, which the actuarial research associates with financial stress, correlates with claim behavior. Length of credit history is also weighted heavily in most insurance models, rewarding the same long-standing account relationships that FICO rewards. New credit inquiries carry a different profile in insurance models, with some research suggesting they are weighted more heavily as stress indicators in the insurance context than in the lending context. The adverse action notice is the mechanism through which most consumers first learn that an insurance score affected their premium. Federal law requires insurers to notify consumers when a credit-based insurance score results in a less favorable rate or a denial of coverage. The notice must disclose that credit information was used, which factors from credit file had the most negative impact, and how the consumer can obtain a free copy of their credit report. Most consumers receive these notices, glance at the required language, and them without connecting the notification to any actionable step. The connection worth making is that the factors listed in the adverse action are the same factors that appear in a standard credit optimization strategy, and improving those factors improves both the lending score and the insurance score simultaneously. The practical steps for influencing an insurance score are therefore not separate from a general credit improvement strategy. Maintaining low utilization, building consistent payment history, preserving the age of existing accounts, and limiting unnecessary new credit applications all improve the credit file in ways that benefit both lending scores and insurance scores without requiring any additional effort or knowledge specific to the insurance channel. The distinction worth carrying forward is awareness, specifically that the credit file you are building or rebuilding has a broader reach than the lenders you can name, and that the premiums you pay every month for products you may have never connected to your credit behavior are part of the financial cost that a strong credit file reduces. Requesting your CLUE report annually through LexisNexis, separate from your standard bureau reports, allows you to review the insurance-related data in your consumer file and dispute any inaccuracies in that file the same way you would dispute errors in a standard bureau report. Most consumers have never heard of the CLUE report, have never requested it, and have no idea what information it contains. Adding it to the annual credit review process takes 15 minutes and ensures that the data driving your insurance premiums is as accurate as the data your loan approvals. The system affecting your premiums has been operating in silence. Now it is not. The long game, how elite borrowers think about credit over decades, a score above 800 is not maintained by people who check their credit every week in a state of anxious optimization. It is not held by people who run calculations before every purchase or who restructure their financial life around the reporting cycle. The borrowers with the strongest credit files in the country are not thinking their score at all on most days, and that absence of constant attention is not negligence. It is the natural outcome of having built a file so stable and so deep that routine financial life sustains it automatically, without intervention, without monitoring, alerts, and without the kind of reactive decision-making that characterizes the early stages of credit building. Understanding how elite borrowers think about credit over decades requires first understanding what a score above 800 actually represents in structural terms. At that level, the payment history is essentially perfect. Every account in the file is current or has been current for so long that any past imperfection has been buried under years of clean history. The utilization rate is consistently low, not because the borrower obsessively pays balances before statement dates, but because the available credit across the has grown large enough over time that ordinary spending produces a low percentage without any deliberate management. The average age of accounts is measured in decades rather than years. The credit mix is complete, and the number of new credit applications per year is small enough that new credit inquiries are a minor and fading presence on the file at any given moment. That combination does not happen accidentally, but it also does not happen constant tactical management after a certain point. It happens because of decisions made years or decades earlier that created an account structure capable of sustaining itself through ordinary financial. The oldest account in a file belonging to a borrower in their 50s was opened when that borrower was in their 20s at a time when the credit limit was small, the interest rate was high, and the card was used for modest purchases. That card is still open. It has not been closed because the annual fee was removed or converted to zero when the borrower called to request a product change 15 years ago. It reports positive every month because the borrower charges a small recurring expense to it and pays the balance in full. It contributes decades of history to the file without requiring a single strategic thought. The mindset difference between a borrower managing their way toward 750 and a borrower sustaining a score above 800 is the difference between optimization and architecture. The 750 borrower is making moves. The 800 borrower built a structure years ago that now sustains itself. The goal of every strategy in this course is not to produce a higher score next month. It is to build the account architecture that makes a high score the natural output of ordinary financial behavior over time. Major life events are where even well-built credit files face stress, and borrowers think about those events differently than most people do. A job change is not just an income event. It is a period during which a mortgage application should probably wait, during which new credit applications should be minimized, and during which the emergency fund that prevents missed payments becomes the most important credit tool in the portfolio. A move to a new city is not just a logistics challenge. It is an opportunity to review the credit file for any accounts that should be updated with new address information, and to confirm that authorized user relationships are still active and reporting correctly. An economic downturn is not just a financial stress event. It is the scenario that a well-structured credit file is specifically designed to survive because the accounts with long histories and low balances continue reporting positively, regardless of what is happening in the broader economy. The insurance principle, in the financial sense rather than the policy sense, applies directly to long-term credit management. The borrower who maintains a low debt-to-income ratio and low utilization, prosperous periods has reserve capacity available during difficult periods. If a medical expense, a job loss, or an unexpected repair creates a short-term flow problem, the borrower with $50,000 in available revolving credit and $3,000 in outstanding balances can absorb that stress without the credit file showing. The borrower who has been carrying 70% utilization across all accounts during times has no reserve capacity when the stress arrives, and the credit file damage from missed payments or maxed balances compounds precisely when the ability to access new credit at favorable rates would matter most. The long-term credit decisions that elite borrowers make without thinking twice are worth making explicit because they are the decisions most people hesitate on or get wrong. They keep the oldest account in the file open regardless of whether it is the most rewarding card in the portfolio. They pay the annual fee on a card with a long history rather than closing it and accepting the age impact. They limit themselves to 1 or 2 new account openings per year at most, and when the new account serves a specific long-term purpose rather than a short-term reward, they do not co-sign for people whose financial behavior they cannot predict or control. They monitor their file annually for errors rather than reacting to alerts from monitoring service, and they treat the credit file as a long-term asset requiring protection than a short-term tool requiring constant optimization. The score above 800 is not a destination that requires constant effort to maintain. Once it is reached, it is the output of a file that was built correctly over time, through decisions that compounded in the right direction. The maintenance is embedded in the structure. The work is in the building. The file you build in silence speaks louder than anything you say. There is in almost every significant lending relationship, where the borrower says, they explain their situation to the loan officer. They describe the circumstances behind a late payment. They provide context for a collection account a period of high utilization, a cluster of inquiries from a difficult year, and the loan officer listens, nods, and then looks at the credit report. Because what is in that file, and what the score derived from it communicates, determines the outcome of the conversation before the borrower says a single word. The explanation follows the file. It never precedes it. This is not a cynical observation about the lending industry. It is an accurate description of how the system is designed to work and why it works that way. A lender evaluating 100 loan applications cannot independently verify circumstances behind every piece of negative information in every file. A consistent, verifiable, objective record of financial behavior across years of account activity is a more reliable predictor of future behavior than any explanation a borrower can offer about past behavior, regardless of how accurate, compelling that explanation is. The credit file is the system's solution to the impossibility of trusting individual testimony at scale. It does not care about your intentions, it records your actions. That structural reality is not something to resent. It is something to understand and to use. The borrower who understands that the file speaks before they do is motivated to build a file that says exactly what they needed to say before any conversation begins, not by misrepresenting anything, not by manipulating data, but by making the decisions over time that produce the payment history, the utilization profile, account age, and the credit mix that communicate financial reliability and the system is capable of reading. The file that speaks for you is the product of years of ordinary decisions, with enough awareness to avoid the mistakes that would undermine it. The borrowers who spend their energy trying to charm their way through a decision, who believe the relationship with the loan officer will overcome what file contains, who think an explanation will neutralize a derogatory mark, are fundamentally misunderstanding where the leverage in the transaction lives. The leverage lives in the file. A borrower with a 790 score does not need a conversation. The file has already done everything that needs to be done before the appointment was scheduled. The rate is determined. The approval is effectively certain. The terms are the best available. The borrower shows up, signs, and leaves. That is what a file built correctly over time produces. Not a favorable conversation. The absence of the need for one. Every topic in this course has been a component of building that file. The authorized user strategy adds account age and positive history. The credit builder loan adds installment diversity. The utilization management strategy removes the drag of high balances. The dispute process removes inaccuracies that misrepresent the actual history. The credit freeze removes the vulnerability to fraudulent accounts that corrupt the file without the borrower's knowledge. The pay-for-delete negotiation removes a collection account that would otherwise sit as permanent evidence of a single difficult period. Each strategy addresses a specific part of the file, improves a specific component of the score, and contributes to the cumulative picture that the file presents on behalf of the borrower who built it. The shift that separates the borrowers who improve consistently from the borrowers who plateau is the shift from score focus to file focus. A score-focused borrower watches the number and reacts to its movements. A file-focused borrower makes decisions designed to improve the underlying structure of the file and allows the score to follow as a natural consequence. Score monitoring is useful as a feedback mechanism. It is not the goal. The goal is a file that is accurate, deep, diverse, consistently positive, and old, enough to carry genuine weight in any lending context where it will be. That file is built in silence. No announcement accompanies each on time. No reward is issued when a balance is paid below 10% of the credit limit on the statement date. No recognition arrives when an old account reaches its 15th anniversary without a missed payment. The building is quiet, incremental, and cumulative, and its output is a document that speaks with more authority than any conversation you could have about your financial character, because it is not an argument who you are. It is a record of what you have done. The borrowers who understand this stop chasing the score. They start building the file. And once the file is built correctly, the score takes care of itself. You now know what separates the 800 Club from everyone else. It is not luck. It is not income. It is not some insider secret that only wealthy people have access to. It is a set of decisions, made consistently over time by people who, the rules of the game before they started playing it. They understood that utilization is calculated from reported balances, not spending, and they timed their payments accordingly. They understood that authorized user status transfers account age, and that knowledge to build a deeper file faster. They understood that a collection account is negotiable, that a credit limit increase costs nothing to request through the right channel, that a credit freeze prevents fraud that monitoring only detects after the fact, and that the account in their file is worth more closed than open only to someone who has never read this far. They understood that the file builds in silence and speaks louder than any explanation they could offer at a loan desk. You understand those rules now. The gap between knowing them and benefiting from them is the gap between moment and the first decision you make differently because of it. That gap closes the first time you pay a balance before the statement closes, the first time you request a credit limit increase through the soft inquiry channel, first time you pull your report from all 3 bureaus and review every line with the knowledge of what to look for and what it means. The next video breaks down the credit report itself, line by line, so you know exactly what to look for, what to fix, and in what order to fix it. That is where the real work begins. Every number covered in this course pointed toward the same place. The 5 components of the scoring model, the gap between FICO and Vantage Score, the weight of a single missed payment against years of positive history, the cost of a collection account left unaddressed versus the outcome of a negotiation handled correctly, the utilization calculation that rewards the borrower who pays before the statement, closes over the one who pays on time, but carries the full balance forward, the freeze that costs nothing and prevents everything, the dispute process that requires only documentation, and the willingness to send certified letter. None of those mechanisms are complicated. None of them require access to resources most people do not have. The barrier was never the tools. The barrier was always the knowledge of what the tools are, how they work, and in what order to use them. You are on the other side of that barrier now. The credit file you build from this point forward is not the file of someone who reacts to the system after it has already made decisions about them. It is the file of someone who understands the decisions before they are made, who chooses accounts deliberately, who manages the components that respond quickly and protects the ones that only accumulate with time, and who arrives at every conversation with nothing left to explain, because the file has already said everything that needs to be said. The system was designed to evaluate you. Everything you have learned is how to make sure it evaluates you accurately. The file builds in silence, the score follows, the money is the point. Start building.